Hey everybody, how's it going? I wanted to put up a video over the weekend so people could take a look at it in regards to a bullish bat pattern that formed with ITRM. I put up a post yesterday that mentioned it completed one on the hourly, and some people didn't know exactly what that meant. A bullish bat pattern, does that mean it's going to go up? Does that mean it's going to go down? Where is the buy point at? What is your profit target? How do you arrive at that? So I wanted to put up a video that shows exactly what it is that I'm looking at with that, and what your buy price would be, what your stop loss would be, also where your profit targets would be, primary and secondary profit targets. So the bat pattern is one of our harmonic patterns. You have a bat pattern, you have a Gartley pattern, excuse me, and you also have a cypher pattern and butterfly pattern. Those are going to be the most common ones. You also have another one called the crab pattern. The ones I like to focus on are bat, cypher, and Gartley. So this one, like I mentioned, completed the bat. So I'm looking at a daily chart right now, and what that means is that every bar that I'm looking at is worth a day's worth of trading. In order to truly see what's going on, I got to move it to a different time frame. And for swing trading, I like to use the 1 hour and 4 hour time frames. So for the 1 hour time frame, that is going to put up this kind of a view, and it's going to be a lot easier for these moves to be seen. So just like a daily, every bar on the daily represents 1 day. This is representing 1 hour. So a lot of this just has to do with going over these patterns over and over and over, and eventually your brain starts to pick up on these things just by looking at the pattern itself. And I can tell just by looking at this, we've had a lot of chop after it made this high right here. And this chop is representing some volatility that when we're in periods of consolidation or things are trading sideways, or even somewhat of a downtrend right here, well, definitely a downtrend, but there's still some sideways action here. When the sideways action occurs, that's when these patterns come up. Markets are in trend or running up about 30% of the time. They're in consolidation about the rest of the 70% of the time. So this patterns tend to come up during periods of consolidation. Now, the first order of business that I'm looking at with this is I want to look at for these what are called the sore thumb moves, moves that stick out like a sore thumb. So at the very bottom right here to the very top right here, that move is also referred to as an impulse leg. That's going to be my first measurement, and that I can also label as my X point, and this is going to be my A point. So I'm looking at an X to A move right here, from here to here. That's my X to A. And that's what's my impulse, referred to as my impulse leg, sometimes referred to as an anchor leg. So what I'm going to do is go to my Fibonacci retracement and measure from X to A. And in order for condition number 1 to be met for a bat pattern, I have to have at least a 50% retracement or a 0.5 retracement. I definitely have that right here. Now, you'll find some material online where they'll refer to a 382 retracement as being satisfactory for condition 1. I've had better success in my own back testing and career with using the 50%. It seems like it hits higher, profit targets hit a higher percentage of the time if I have a 50% rather than just a 382. So condition number 1 of a retracement of X to A has to be at least 50%. It can go all the way down to a 618, but it cannot touch the 618. Once it touches the 618, it's invalid for a bat pattern. Now you're starting to get into the qualifications for a Gartley pattern. That's a totally different thing. We're just going to focus on the bat pattern right now. And like I said, condition number 1 is at least a 50% retracement. So I'm going to actually write that in here. Condition number 1, X to A must retrace at least to the 0.5 and cannot touch 618. Okay, so that's condition number 1. And condition number 1, as I mentioned, was met right at this point in time right here. So I'm going to now label that as my B point. That's going to be B. I'm going to take out this shaded area right here. So for condition number 2 to be met, I have to have at least a 382 retracement from A to B. So I draw from A down to B, and I can see, do I get at least a 382 retracement? I absolutely do. In fact, I almost get a 50% retracement as well, but I only need the 382 retracement in order to satisfy condition number 2. So I have condition number 1 that's been met and condition number 2 that's been met, and that is going to be now my C point. Okay. So now I'm looking for D point, which is going to be pattern completion, and at pattern completion, that is where your buy is at. Pattern completion, I go back to my first measurement of X to A, and pattern completion is going to come in right at the 886 retracement of X to A. In fact, let's go back and write this in here too. For position number 2 or requirement number 2, that's going to be A to B must retrace at least 382. It can go all the way to A point, but cannot close above A. Okay? Let me just explain what I meant right there. So if this decided to not stop at the 0.5 and it decided to go all the way up to A, that is a valid move still for a bat pattern. It can actually, the candle wick can extend beyond A, but it cannot close above A. Okay? So it has to be at least a 382. It can go as high as A, but it cannot close above A. If it closes above A, then the pattern's invalid. So for position number 3, I mentioned D point is pattern completion and the buy. D point for completion is at 886 of X to A. Okay, so that is going to come in right here. And as I mentioned, that means that is going to be our buy, and it's coming in right here at the 886. So our buy would have been right at $1.42. So I know that I'm going to enter the market right here at that green line at $1.42. Now what that does is, since we have X right here that comes in at structure, that helps us figure out where we're going to put our stops. Now our stops are going to have to go below X, and I would say a good place to put a stop is going to be just distance-wise. As I eyeball it, I like this area right here. As I draw it in, that comes in at $1.02. Now, one thing that you want to stay away from in terms of putting in stop losses is you want to stay away from keeping them around even-handled numbers. And the case being in point, just exactly what happened right here. Or not exactly what happened right here, but if it were to get down to this level, people like to make decisions at even-handled numbers, whether it's $1, $1.50, $2, anything. Our brain likes rounded numbers. And if you put a stop loss right at a rounded number, a lot of people will figure in their minds that if it gets down to $1, I'm going to be a buyer. Other people are going to say that if it gets down to $1, I'm going to be a seller. You typically have a lot of decisions made of those even-handled numbers. So I think in this situation, it would definitely be best to get that below the even-handled number, maybe come in about 95 cents. And you can see price action came down. It retested structure at X, and then we get some really nice reversal candles coming on up. But what all this does, when I know my purchase price and I know my stop loss price, I know exactly what my downside risk is going to be. So I'm purchasing at $1.42. My stop loss is at 94 cents. That represents about 34% to the downside. Again, that stop loss is based off of structure. I'm assuming that if price action were to get down that low, then structure has definitely been violated. That psychological even-handled number at $1 has been violated, and I don't want to be in the trade. But it's not just a matter of being in a trade and saying, well, okay, well, if price action goes down 5 or 10% below from where I bought it, then I don't want to be in the trade. That doesn't really make a whole lot of sense, because if you purchased right here at $1.42 and then you get a retest of structure here at X, you're down 14%. But most importantly, you're going to be right down here at structure support. Is it going to hold or is it not going to hold? Well, we know right here that it did hold and then it reversed. So if you got stopped out right down here because it was too much pain at 14% down on your position, well, then you would have missed this reversal right here, and I think there's more to come next week as well. So before we even get in the trade too, we also know where our profit targets are going to be. Profit target is going to be figured, I'm going to move some of this out of the way so we can see a little clearer here. Profit targets is going to be determined by drawing another Fibonacci retracement from A all the way down to the bottom of the move. If it turned around right at the 886, which does happen more often than you'd think, then my measurement would be right here. But since price action came all the way down here, I got to draw to the bottom of these candle wicks right here. And my first profit target is going to be at the 382 retracement. And that, change the setting here real quick. That's fine. So my profit target is going to be about right here. Now, what I would definitely want to shoot for more often than not is I want to shoot for a risk-reward ratio of at least 1-to-1. I'm a little bit below it right now because my stop had to be very generous to get around that even-handled number. If I did move it up to say maybe about 97 cents, that pushes my risk-reward ratio up a little bit higher to almost about a 1-to-1. Now, what that means is that for every dollar that I put up in this position, I stand to gain almost $1 to the upside. So when this type of pattern completes, I am going to be able to hit profit target number 1 about 70% of the time. So if I have a 1-to-1 risk reward ratio, and if I put $1 up, stand to gain $1 for every dollar that I would lose, if I'm right 70% of the time, then mathematically I should be making money on this. And if I'm going to draw on this pattern, I should have done this before. If I'm going to draw on this pattern, this is what it would look like. X to A to B, B to C, and then D completion right here at the 886. That's what the pattern looks like in itself. Now again, price action, we've had so much pressure this week, selling pressure. It came all the way down, retested X, and now we're in the middle of a reversal. But I also know what my profit target for target number 1 is going to be at $1.83. Stand to make, I'm going to front load that a little bit, about $1.84. And about 29.5% to the upside versus about 31.69% to the downside for profit target number 1. Now I could do extended targets, secondary targets on it, and that would be at the 618, the golden mean Fibonacci. So my 618 comes in right here at about 229. I would front load that order just a little bit just to make sure I get filled at about 227. Total would be about 59.86 for secondary targets. So how would I play a secondary target on this? Well, once my first target is hit, I would cash out half the position, pocket that, roll my stops to break even. So now I'm on a risk-free trade, and then let the rest of the position go. And either one of two things are going to happen. Either A, I'm going to get stopped out at break even, but I still made money on the trade, or B, I get taken out at profit target number 2 at the golden mean Fibonacci. If you're not familiar with Fibonacci, I highly recommend you do some research on it and understand what the two main Fibonacci numbers, the 382 and the 618, actually mean. They're very, very powerful tools to use within your trading, especially when you apply them to harmonic patterns such as this. So that's basically the bat pattern and the rules behind the bat pattern. Let's scrunch it up here so we can see those rules again. But when you're talking about a bullish harmonic pattern, that means your reversal should happen to the upside. If it's these happen bearish as well. You can have a bearish bat pattern as well. You're expecting a pattern completion for there to be a reversal to the downside. Now keep in mind too that this is a counter trend trade. Any way you look at it, it's counter trend. We are in the process of making lower lows and lower highs all the way down. I would really like to see this get above that $1.87 or $1.88 mark, about right there, because if price action were to go up to here, move past there, past this line right here, then that would dictate a technical change in trend. And I think in the long term with ITRM, we're just looking at a really nice move with this. The market's just been absolutely terrible lately, but I think this is one of those stocks with the defined catalyst coming up with their PDUFA date in July. Not to mention, nobody's talking about this online though, not to mention an AdCom meeting is going to be announced at some point in time too. That's going to be before the PDUFA, and that's going to provide another defined catalyst as well. I think in this kind of market, when you're dealing with stocks that have defined catalysts, that's going to be very important, a really great safety net, and that's going to happen. Now, I wouldn't recommend at all holding a position, or at least a large position, through an AdCom meeting, because if the, sorry about that, I would say if the data or the panel recommends against it, then that is obviously going to be devastating to the position. I would recommend just cashing out by AdCom, seeing how things go with the AdCom, and then if it's positive, which I'm anticipating it would be, there'll definitely be a point in time to jump back on the trade and follow that into PDUFA for another run. So that's what I see with ITRM. I think it's going to be a great hold. We just got to get through this whole correction right here, which I think next week is going to be really nice, and go from there. So anyways, best of luck with your trading. Hopefully this helped, and I'll talk to you soon.